Hello everyone and welcome to this new video on Web Entrepreneur Diaries. And today we're going to talk about how to trade gappers. And so we need to first make sure that we understand what we mean by gappers, and especially, I mean in this case, with small caps. And in particular, we're going to check three relatively low risk setups that you can trade on small caps. So let's start. First of all, what is a setup? A setup is basically a condition that you can see on a stock chart that presents some kind of features that are often repeated, and they can be based on the candle charts, or the candles and some indicators like the EMAs here, or the volume, or other indicators like RSI, or different candles like in this case the Akanashi candle. It really depends, but the main idea is that it is a condition that shows up in some moment. Second thing to know, what do we mean with the small caps? Small caps, as illustrated on a video that I made some time ago, are stocks that have usually low float. With low float I mean below 300 million shares, and relatively low price. So let's say below $30 and 300 millions. That's already a mid-cap stock, but just to give an idea, we're referring to stocks that I usually screen with my small cap gapper stock screener, which you can find the video also on the channel. And as you can see, like for example, these are from last Friday, and they have a price between 9 and 2. These are the leading gappers. A float between 92 millions here and 15 millions, but they can be even smaller or larger, at least in some range. And those basically are what I'm referring to as small caps. So let's close the scanner that right now we don't need. Third thing to know, when do you trade, or would you prefer to trade small caps during the day? There are basically three moments where I would consider taking a trade with the small caps. The first one is pre-market, and this also depends a bit on when this is happening. Like some moments of the year, pre-market may be stronger, some others may be a bit weaker, but they often show some activity here in pre-market. You can see on this slightly orange area that's pre-market, and they make some kind of moves, okay, during this time. So it is a moment when it is possible to trade gappers. Another moment is the open, not really the first candle. I mean, that can be, but that's a bit more risky, so we won't talk about it, at least in this video. Or another moment where you can trade gappers is power hour, which is very late on the day, last hour of the market, and even after hours sometimes. As you can see, they move, but I usually prefer pre-market. And the reason is that as they're gapping up for the first time after a few days, they don't have resistance from the same day. And so it's easier to identify levels of resistance and support based on the previous days. Usually you have fewer, so it's cleaner. But it can change, so sometimes conditions may be different, and you need to be aware of that. We are now at the point where we should start to describe these three setups that I wanted to talk to you about. And these three setups that I've selected have a relatively low risk. With that I mean that usually the chances that they will result in a winner are bigger than the ones that they would fail, which doesn't mean that will be any guarantee that they will succeed. That's never the case with any combination of setups, indicators, stocks, whatever. There's no guarantee in the market of making money. To be honest, there is almost a guarantee that you will lose money based on the statistics, so keep that in mind. These are three relatively low risk setups. The first one is the first 5-minute candle, so we're looking at this chart here, to make a new high above view up. The situation here is this one, basically. We have the stock going high, the first gap during the morning. It makes a push, then fades, then reclaims view up, which is this orange line here. It breaks through it. It can also get down again. It doesn't matter actually for this kind of setup, but what matters is that once it makes a new high above view up, then there is a good chance that it will continue. And we will go in detail in another video on how this is, why this happens, or why sometimes this happens. But the main idea is to trade the first 5-minute candle to make a new high above view up. We can see this on ABSI from a few days ago. Then also IMMX shows a similar setup here. As you can see, it goes below, it makes the first push, goes below, then it tests view up here, but doesn't break, which is important. You don't need to get in when it breaks. You have to hold and wait for this low risk setup. Then you can also take a quick stab when you want, but that's a completely different situation. And as you can see here, it breaks the first 5-minute candle, making a new high above view up, and then it continues to go higher, which may be the case, may not be the case, but what matters is that, as you can see here, it never, if you place your stop correctly here, no, like the low of this candle would be the absolute stop, but even if it's smaller, no, like the pivot here, you would have never been stopped until very late in the day, maybe. So that's clearly some kind of good potential setup. The risk here is very small compared to the possible outcome of the trade. The second setup instead is on the 1-minute chart and is a bit more risky. I've tried to put them in a different, in an order of risk, but it really can change, so I wouldn't consider them like a strict order of risk. Let's say that's a bit more risky, this one. The first 1-minute candle to make a new high after the first push. We can see this one on here, and we will look now at this chart, the 1-minute chart. This is usually my my trading view layout that I use for trading, and there is a video also for this one, how to make it, so you can check it. I'll link them, all the videos I'm referring to, I will link them in the description below. And as you can see here, this is a pretty tricky one to take, to be honest, but it usually gives some positive outcome. On the first push higher, you basically wait for the first pullback, and then when the first candle that makes a new high happens, you try to jump in right as it breaks. You don't anticipate this one, because they can go down quite a bit, as you can see here, for example. Here it worked, no, this one here, but sometimes they can go, let's see if we can find, like let's say you want to anticipate, here for example it didn't work very well, but sometimes they go really further down, so it's better to wait, no, instead of taking them way too soon. These are very similar ones. ISIG is a bit tricky, but let's take on ears. So the setup here would be jumping on the first sign that the candle is making a new high, and jump out quite quickly. at least with part of your position. You don't want to hold these ones for a long time. It's a 1 minute, it's a trade on the 1 minute chart, so it's better to time it on the 1 minute. They can still go higher, as you can see, but they're usually better for quick profits rather than holding for a bit and then wait to see where they want to go. If you want to do that, it's ideal maybe to sell part of your position on profits as it pushes higher, let's say 20, 30 cents, depend on the price of the stock clearly, and then sell the rest when you feel appropriate. It could be you don't sell unless it makes you again break even, like here, so you would have sold the other half at break even here, or in some other situations maybe a bit further up. Yeah, here as well, for example, this would have been better, like it pulled back, made a new high, went up quite a bit if you consider the price of the stock, which is very cheap here, made a pullback, kept going higher, so theoretically it gave more possible entries for other people. So if you take this first one and you save part of your position, you can keep holding it for quite a bit. There are very different ways to define a possible target or stop. We will discuss them also in another video. The last setup that I want to talk about here, and that I consider relatively low risk, is the first 1 minute candle to make a new high on the first healthy pullback. So first thing, what is a healthy pullback? Is something that I described in a previous video, and you will find in the description the link for this video. But for this video here, I can simply say you should look for something that looks like a pullback and is a moderate pullback. So compared to the push higher, like here, and I think here on tier B, yeah, this is a very good one, and you can see it's not during pre-market, but a bit after the open, like 1 hour after the open. This is a very nice pullback. You have a push higher that breaks through the high of the day. Then you can see the volume increases in the push higher, which is very good. The volume decreases here on the pullback. The pullback doesn't really break too much, like the low of this candle, it breaks only here, and this stays near this range, no? It's still holding very well. It's taking time to allow the stock to consolidate in this area of price, no? And then the first 1 minute candle to make a new high here is the good one. This is also the break of 10, so once it breaks 10, you can have the first target is pretty near, 10.15, but also the stop is pretty near, it's below 970. And then you can hold it a bit and see when it wants to stop. You shouldn't hold it forever, clearly. It's still a 1 minute, a trade on the 1 minute chart, so keep it short, no? So it's nothing here is to hold forever or for a day or for a few hours. Most of the cases you will be out in 1 minute, 2 minutes, sometimes in 5, 10, 15 minutes, it depends on the trade. And this is an example. So just to sum it up for this video, we have checked a few trade ideas and trading setups that I would consider low risk for gappers, especially on small caps. Sometimes this can be risky in the term that they have a risk associated anyway. You will never have a guarantee win on any of these setups, on any stock, and there are many reasons why this can happen. I will discuss them maybe in another video. But the main idea is these three setups usually give a higher chance of success for a long trade. I'm talking about long trades here, rather than a failure. And they allow your stop to be quite small compared to the possible positive outcome of the trade. And so they're viable, they're good, in my opinion, they're very good setups. So that's for today, and I hope to see you soon. Remind to If you have any questions, to just ask them below and in the comments. I'm happy to check them out and possibly help you out. See you soon, and bye bye.